Welcome back. We shall learn another method to value options using the Scholes Merton model. We shall learn the model in the context of options on non-dividend paying stocks, options on dividend paying stocks, and options on currency exchange. Lastly, we shall learn the basic assumptions of the model. Let's dive right in. Let's get the hardest part of the BSM model out of the way first. These are the formulas for valuing European options on non-dividend paying stocks using the BSM model. Now, before you faint from the complexities of the formulas, let's first learn how to interpret the model, starting with a call option. We know that the value of an in-the-money call option at expiration is ST minus X. In our discussion on forwards and futures, we learned that the forward price must be compounded by the risk-free rate for no arbitrage opportunities to exist. As such, the no arbitrage expected future value of the stock must be compounded by the risk-free rate. We use continuous compounding in this case. However, since a stock is a risky asset, the payoff at expiration is uncertain. We model the uncertainty with a standard normal distribution with mean 0 and standard deviation of 1. You do not need to understand the details, just that this uncertainty is modeled with two parameters, ND1 and ND2. ND1 is the adjustment for the stock price at expiration, and ND2 is the adjustment for the strike price. Taking into account uncertainty, the payoff at expiration can be expressed in this form. Since we wish to estimate the present value of the call option at time 0, the BSM value can be thought of as the PV of the expected option payoff at expiration. The model assumes continuous compounding, so we discount the payoff by e to the power RT, where R is the continuously compounded risk-free rate. So based on this expression, which takes into account uncertainty, the PV of the payoff is therefore as such. This is how the expression of the BSM model for call options on non-dividend paying stocks is arrived. Now let's learn more about D1 and D2, which are crucial parameters of the BSM model. D1 and D2 are functions of the stock price and exercise price, the risk-free rate, price volatility, and the time to expiration. N is the standard normal cumulative distribution function, that is the probability that a random sample is lower than D, represented as the area below the curve, so ND must be between 0 and 1. There are a few properties that you should know. First, D1 is always greater than D2, so ND1 must be greater than ND2. The standard normal distribution has a mean of 0, so if D is greater than 0, ND will be greater than 0.5. And lastly, since the distribution is symmetrical, N minus D must be equal to 1 minus ND. This property is important for the valuation of put options, which we'll learn later. So, for example, these are the relevant estimates for a call option that we are valuing. Plug all the figures into the formulas, we get D1 equals 0.7905 and D2 equals 0.3662. If we look up these figures on the Z table, we get 0.785 for ND1 and 0.643 for ND2. If all these calculations scare you, the good news is that ND1 and ND2 are often given in the exam, so you most likely would not have to remember the formulas for D1 and D2 for the exam. In any case, we apply ND1 and ND2 to the calculation of the call option. We get an estimate of $14.10 using the BSM model. Similarly, you can derive the BSM model for valuing put options using the same approach that we just went through. We'll not go through the steps, as you can see the similarity to that of the call option, just that the derivation is based on the put option payoff at expiration, which is X minus ST. You should note that the parameters are minus D2 and minus D1, which means we're referring to the right-hand side of the distribution. They are easily calculated as 1 minus ND. So you may want to take it as an exercise. Given all these parameters and ND1 and ND2, estimate the value of the put option using the BSM model. Well, this is just a matter of plugging in the figures to the formula, keeping in mind that N minus D is 1 minus ND. You should arrive at $3.22. Alternatively, the BSM model can be described as having two components, a stock component and a bond component. For call options, the stock component is this term, and the bond component is this second term. The BSM model call value can therefore be replicated with a long position in ND1 shares and a short position in ND2 zero coupon bonds with face value of X. The net cost for replicating the portfolio at initiation is equal to the value of the call option. Similarly, the BSM model put value can be replicated with a long position in N-D2 zero coupon bonds with face value of X and a short position in N-D1 shares. The net cost for replicating the portfolio at initiation is equal to the value of the put option. If you work out the cost of the replicating portfolios based on the same parameters we used earlier, you should get the same values for the call and put options. The BSM models that we've gone through apply only to options on non-dividend paying stocks, that is, underlying that do not carry benefits or costs. For options on underlyings which carry benefits like coupons and interest, slight modification of the BSM model is required. Let's go back to our derivation of the model. In the case of stocks that issue dividends, we assume that dividends are regular, so it can be modeled using a continuously compounded dividend rate, which we denote as gamma. If you think about it, dividends benefit the short, so the long should be compensated with a lower call option value at initiation. That is, the long buys the option at a discount. We therefore multiply the long stock term with the discount factor to account for the dividends that the long will miss out on. If you look at it carefully, this is just an addition of this term to account for the continuous compounded dividend. This is the benefit-adjusted BSM model. Likewise, you can make the same arguments for the put option. Again, the only adjustment to the model is this discount factor to account for the dividend. Do note that the dividend adjustment should also apply to the calculation of D1 and D2. The only adjustment is to subtract the dividend rate from the risk-free rate. In aggregate, dividends have the effect of a lower D1 and D2. The net effect of carry benefits is that the value of call option is lower, while the value of the put option is higher. Another way to help you remember the formulas is to take the perspective of a replicating portfolio. The stock component should be discounted based on the continuously compounded dividend rate, and the bond component discounted by the continuously compounded risk-free rate. The benefit-adjusted BSM model can also be applied to options on currency exchange. Currency options are defined by the exchange rate, where there is the price currency as the numerator and base currency as the denominator. The price currency is also often defined as the domestic currency, so the base is the foreign currency. For currencies, the carry benefit is not a dividend, but rather interest earned on a deposit of the foreign currency. Gamma is therefore the continuously compounded base currency interest rate, while R is the continuously compounded domestic currency interest rate. Let's practice. An Australian firm buys parts from Germany in euros and would like to hedge against an appreciation of the euro against AUD. The AUD per euro exchange rate is currently 1.5. Should the firm long a call option on AUD euro, long a put option on AUD euro, or long a call option on euro AUD? Pause the video now and work out your answer. And we're back. The correct answer is A. The current AUD euro rate is 1.5, and the firm is concerned that the rate will increase. That is, it requires more AUD to buy €1. To hedge this risk, the firm should long the call option, that is, it benefits if the AUD euro rate increases. So the firm longs a call option with the following parameters for the BSM model. Estimate the value of the call option on AUD euro. Do note that prices for currency options are often quoted in units of 100 times the exchange rate. Pause the video now and work out your answer. And we're back. Well, this exercise is mainly to test your ability to identify the various parameters for the BSM model. In particular, you must be very clear which rate is gamma and which rate is R. Interest earned on the foreign currency is the carry benefit, so gamma is the euro interest rate. Plug all the appropriate figures into the formula and you get a call option value of 11.53. This is in terms of the price currency, so the call option value is $11.53. Besides the principles of the BSM model, it's very important to know the assumptions underlying the BSM model. Let's conclude this lesson by going through the basic assumptions. Firstly, the assumption that the underlying asset price follows a geometric Brownian motion process. The continuously compounded return is normally distributed. The volatility of the returns on the underlying asset is constant and known. Additionally, the price of the underlying changes smoothly, that is, there are no abrupt jumps in price. Also, the continuously compounded risk-free rate is constant and known. Borrowing and lending are both at the risk-free rate. Likewise, the continuously compounded yield on the underlying asset is constant. Markets are assumed to be frictionless. There are no taxes, no transactions costs, and no restrictions on short sales. Continuous trading is possible, and there are no arbitrage opportunities in the marketplace. And lastly, the options are European options. That is, they can only be exercised at expiration. And that concludes this lesson on the Black-Scholes Merton model. Admittedly, the calculations are tedious, but they're not too hard to understand if you follow the reasoning. In our next lesson, we shall learn a modification of the BSM model known as the Black model. See you soon.